Matt, welcome to the Roundtable, episode number 15. Good to see you.
Good to see you. Thanks for having me.
Fellow Maryland resident. I grew up in Maryland, live in Atlanta, but we are also, as we know, Commanders fans, so we can be sad about that together, but it's good to see you.
The lifelong depressed fan.
I know, we got a new owner. It's been 20 years, but better days ahead. Talking about accounting, finance today can be exciting topic, can also not be an exciting topic. You got any accounting jokes off the top of your head? That would be something to liven things up a little bit.
At our firm, our entire team counts.
There you go.
More of a slogan than a joke, but I'm better with the slogans than I am the jokes. I've never heard anybody tell me that talking accounting is exciting or interesting, but typically is something that is necessary as a
What's
business.
not exciting and interesting is running out of money and shutting your company down. So it is a necessary evil. I looked up a joke before this. Why did the accountant break up with the calculator?
Give it to me.
Because he felt like he was just pushing its buttons. So now we've got some fun here for the accounting side. So Matt, for everyone who doesn't know you, you've been running your business for almost 20 years. Tell me about how you first got into the accounting industry and sort of what's led you to this point today.
What got me into the accounting industry? So I mean, this goes all the way back to high school, and I'm going to try to keep it really short. So I thought I was going to go criminal justice. I was going to break down doors. My best friend's father was the deputy chief financial officer of the National Credit Union Administration. Said, "Do you want an internship?" Sure. Got me in there. I ended up working with a budget director, and I was good with numbers. I said, "No, I better go with what I'm good at, because I'm not so sure I'm good at knocking down doors." So it really shifted me into that. Really started in forecasting, and then majored into accounting. Started working in accounting in college, doing some night school and working as a bookkeeper, office manager, and then controller. And then I was able to parlay that into starting my firm. There's a much longer story, but then we wouldn't get to any of the questions.
Fair enough. And you started your firm, it's just you or maybe a couple people starting. You've got, I think, almost 100 employees now, which has been awesome to kind of hear about your journey. How has the accounting industry changed in 20 years? Has it changed very often? Is it an industry that's rapidly changing? Or, I mean, talk about how things have changed since 2006 when you started.
So I think the best way to put this, I started the company in 2006 with no money and my business partner. Me and him, we were high school best friends and lived during college and worked together when I was a controller. And we started with one company, and that's it, as a client, in the attic of the house that we were living in. And I posted on Craigslist accounting services. And in something like 18 months, we grew to $500,000 in revenue just from posting outsourced accounting services on Craigslist. Which, let me tell you something, if you post outsourced accounting services on Craigslist these days, you will not get clients. When we started then, outsourcing in the accounting realm was just something that wasn't really considered what a CPA firm would do. Not a lot of people were doing it. And so there was and there wasn't a ton of competition. We fast forward all the way to today, and every CPA firm wants to invest in what they now call client advisory services around outsourcing, because it's recurring revenue, but also because it's really what drives the success of businesses. If you have good financials, you know how to make decisions that impact positively your business moving forward.
I like that. So sort of getting into things a little bit, when you're thinking of, talking about the equipment rental industry, you serve other industries as well, but you have experience in the equipment rental industry in particular. What's the first thing you would look at to see if the financials are accurate for a rental business?
Well, let me first say that there's just a core set of principles around accounting that it doesn't matter what industry you are, that you really need to do well and do right to be able to rely on those financials for accuracy and to provide yourself with that guidance. Because let's be honest, the financials, your accounting is, a lot of times in a business owner's mindset, is an administrative function in a lot of ways. And what we try to do is shift that mindset and say, look, this is a function of your organization that allows you to plan your growth, to plan your success, to help guide you through the times that you have that are cyclical. A lot of businesses, I think, equipment rental, especially, has seasonal components to it, and so the financials help you know when those ebbs and flows are. Those helps you plan it. To answer your question, a lot of business owners focus on their income statement or the profit and loss statement to really tell them what's right, what's going on with the organization. And they don't focus as much on the balance sheet. Well, where we look at first and foremost for accuracy is how accurate the balance sheet is. Now, let me not take away from the value of the income statement, because that's where you categorize, you understand what revenue you have, how that revenue is broken down, what your direct expenses are, what your gross profit is, what your overhead expenses are. But if your balance sheet isn't right, I can guarantee you your income statement isn't right. If I can easily post a entry that hits the balance sheet and the income statement, and it completely throws off, I could increase revenue that way if I never reconcile the balance sheet. That's why we always focus on maintaining retained earnings, carry forward accurately from the tax returns and from the reporting. That's why we reconcile bank accounts. That's a balance sheet item. Why we reconcile credit card accounts. That's a balance sheet component. Why we look at any one of those accounts and make sure we have work papers around them. Then we can shift to the income statement. We can make sure it's categorized and know that, hey, what's being reported is accurate. The net income is accurate, and so forth.
Interesting. So you guys start with the balance sheet first to make sure that's accurate. If that's not accurate, then you're gonna have some other issues before you get to the P&L. What in the balance sheet are like the top 2 or 3 things you guys usually see when things are off? Like what's causing things to be off?
So let me just emphasize this. So what we offer to any potential client, what we call an accounting analysis, and really what it is a balance sheet review.
Mm-hmm.
And it highlights, we do something we call questions and concerns and recommendations. And we take our review of the balance sheet. Now we do go over to the income statement, but it all starts on the balance sheet to talk about what questions and concerns we have about how you're operating your books currently. So I just want to emphasize that component of the balance sheet. Does that answer your question?
Yeah, for sure. And I guess after the balance sheet, you've got that accurate. Then what are you looking on the profit and loss? What do you look for there to make sure things are accurate?
Yeah. So from a P&L side, it's how we're categorizing information is really what speaks and starts to create a story. And we talk about storytelling in accounting. Your financials really are like a book in a lot of ways. You have monthly, quarterly, annually, you look year over year. And the way you categorize your information is really how you expand it from being, let's call it, at least when I was in high school, Spark Notes, versus the full novel. And so let's say that from a revenue standpoint, we want to understand heavy equipment versus tools, and that we also break that down from a cost of goods so that we know that our profit margins, our gross profit margins between the two, what the difference is. And that can tell us and guide us how we want to approach future growth. Then it's labor costs, it's your overhead, and really having a consistency of that data entry. So if we are able to review a profit and loss detail report month over month, and we see there's a consistency of entry, meaning the same vendors are going to the same place, we can now do trend analysis around that and make sure that there's accuracy and is telling us, hey, these type of expenses move at a certain pace to the growth of the company.
Yeah, so essentially you want to have everything, you want to have consistency over periods of time, and then you can tell the trends, you can tell the story. What we've heard from a couple other guests who have sold their rental business to large national players, a lot of the reason they were acquired, a lot drove the sale, was that they had their books in order and consistency over several years. And it just made the transaction process really easy. And also gave them credibility that these guys know what they're doing. Even if the numbers with the exact same number for someone across the street, it was all over the place. The fact that they had everything in order, consistency, it just gave them a lot of credibility going through a sale process. So I think there's also external importance here as well.
Well, I mean, I think you can't speak enough to that. When an organization, especially national players or private equity firms that are rolling up, certain industries, look at targets, if they don't, if the current business doesn't have good, accurate, and well-organized financials, it in turn speaks in a lot of ways to how those owners are perceived and how they operate the rest of their business.
It's like getting your house in order, like if you have guests over and you got stuff all over the place, I may think about you differently than if you had a clean house and things were put away. We talk with a lot of equipment rental owners, very small to much larger, doing tens of millions, hundreds of millions of rental revenue. At what point on the small side do you need to start bringing in an accounting professional to help run your books? Because if you got 10 skid steers and you're sort of maybe on the smaller side, that may be a different story than you're doing millions of dollars of revenue. Is there a point where I guess my question is is there a reason why people should not have an accountant from day zero to help with this? How do you think about that?
Let's sort of define the accountant role. So I look at two different sides of it. You have your tax accountant who is in charge of preparing your annual taxes. Now, whether you're a pass-through, report on your Schedule C, or you're a S corp or a C corp, in which you have a separate tax return that then kicks out a K1 or so forth to your personal. That's one skill set, one part of the accounting realm. Then you have your internal books, okay, and that's the day to day, the week to week, the month to month, and so forth that needs to happen. I'm going to answer your question by first to say the attention to that needs to be, in my opinion, immediate. The day you open, you should invest, whether it's your time or a firm's time, into making sure it's done right and done consistently, because that's good business habits. Now, if you're a startup or a very small organization doing 200, 300,000 in revenue, you might not find the ability to justify bringing in a firm to do that. We have minimums. Most firms have minimums of what they're willing to jump into, but there's just a basic level of work that needs to get done. And, we have to manage multiple accounts. That being said, we typically see organizations start needing some level of outsourced accounting at about $500,000, and definitely at about $1 million in revenue, they should be having some level of outsourced accounting, whether that's even just oversight on an internal resource. But I would say that at the minimum, $500,000, if you don't have that relationship, it's time to start thinking about it.
Yeah, that's a good rule of thumb. 500,000, start thinking about bringing on someone outsourced to help. What about bringing someone full-time? At some point, you've become so big that you need someone full-time, day-to-day, running your books. Do you have a rule of thumb for that? Is that usually, what, 3 million, 5 million? Obviously, it's probably a little bit bigger.
So there's a difference between full outsourcing, co-sourcing, and fully in-source, okay, in our world. So we have clients that we're 100% the accounting department. There's nobody on the other side besides maybe the owner or administrative assistant. We're doing 100% of the work. And that's fully outsourced. We have the majority of our clients sit in co-sourced model, meaning there is somebody internally that's doing a part of the accounting, and then our job is to close on a monthly basis, act as a continuity plan. And this is a big part of it, is maintaining the institutional knowledge of that business that for our clients, so that if their bookkeeper finds their job, wins the lottery, they're not scraping and scratching for somebody to come in and lose that. Then there's a point at which organizations decide, and I would say 10 million and up, that's even pretty low at that point. And we have clients up to 50, 100 million at times. And it's really changed by industry and number of employees. But we have some organizations that would prefer to just fully outsource even at that height of business. That becomes a personal decision. How much do you want to invest on an accounting department and managing an accounting department and knowing what the best software is and knowing what the change in trends are and everything else, versus not. So that becomes more personal.
Well, like what you're saying about on the consistency side, like for us, we've had the same person help with us for the last few years. This morning, she sent me our preliminary numbers for January. And like, because me and her have been doing this long enough, we know very quickly what's good, what's bad. Within 5 seconds, you can kind of look at it. And that is like, you make the investment, at $500K of rental revenue, and you're starting to pay for an accounting, and you're seeing the cost of that. But months later, you see the benefits of that, because then you can start telling that story and starting to see those trends that you're referring to.
Absolutely.
And talk to me a little bit about some of the, I guess, like the real-time financial information that any rental business owner should be thinking about and looking at it on a regular basis.
So I'll go to the most general, and then we can get into specific to equipment rental companies. So I like to start with cash flow. At the bare basics, understanding your cash flow on a month-to-month basis. That in turn is really going to allow you to understand the investment. And equipment rental companies are very capital intensive. I mean, you're buying equipment to lease or rent out to end customers, whether that's from a commercial perspective, B2B or B2C. And your cash flow is going to determine your ability to one of two things: self-finance acquisition of equipment, or to go to a bank or a funding institution to show that you have the liquidity to actually get the lending to buy the equipment. So cash flow is the first thing a business owner should be really focused on. I want to talk a little bit about the difference between cash books and accrual books. I think this is very important for business owners to understand. Most organizations, especially in their infancy and earlier years, focus heavily on cash basis financials. Now, why wouldn't they? Their taxes are done on a cash basis. Cash is king. We always operate in that way. But cash is a backwards looking thing. Cash tells us what we received from what we billed in the past and what we paid versus what we expensed in the past. And you think about it this way: if I have net 30 term on a heavy equipment and I invoice it in January, I'm not getting paid in February. And so when I close my February books on a cash basis in March, all I'm really being told from a business perspective is what happened in January all the way to March. You see that disconnect in timing, that means that we're not as quick to make decisions based on what's happening. Accrual, on the other hand, is when we report the financials as it happens. When the invoice is posted in January, we incur revenue. When we get a vendor bill in January, but we haven't paid it, we incur the expense. And now, when I close my January books on an accrual basis in February, I know what happened in January, and I can forecast what will happen from a cash basis in February based on my accrual. Now I have a multitude of ways of doing this. Now again, that's generic to any business, but where we believe accrual, or at least what I call quasi-accrual, I don't expect cash-based organizations to go full GAAP compliance, but to know what's important from the accrual side of the house, how that can help you as a business owner understand how your business is operating today. Now, if we go into equipment rental as an industry, there becomes non-financial indicators that help make decisions. And what I talk about is statistical numbers. Now, your normal accounting system like a QuickBooks won't help with this, but you have things like Quickly that can. And it's like number of man hours per equipment, and understanding when equipment it's the right time to sell the used to get the new, because repair and maintenance is going to increase, and therefore your true profitability within a subdivision or item group. When I say item group, a type of equipment is going to start going from highly profitable to less profitable to potentially not profitable because of the upkeep and so forth. One of the greatest things that that equipment rental organizations can do to be successful is understand that bell curve, understand when the right time to sell, purchase, acquire new, and follow that path.
So it sounds like there's you really want to use cash and accrual accounting sort of in parallel. There's benefits to both. Both help tell the full picture, but don't overlook accrual is what you're sort of saying.
Yeah, I would say that I would assume the majority of your clients and the majority of the attendees here focus on a cash basis and report taxes on a cash basis. And if you're not looking at your accrual as well and knowing that your accrual is accurate, that's an opportunity to be one step ahead of your competition.
We got a question from the audience. With accrual-based accounting, is there a situation where I would end up paying taxes on invoices I have not collected on? Do those unpaid invoices eventually become write-offs?
So I am not suggesting that you change your tax basis of accounting to accrual. I am suggesting that you operate your internal reporting to include accrual accounting. So as long as you're still operating, or not operating, as long as you're still reporting your taxes on a cash basis, you'll never have to worry about paying taxes on invoices that have not been paid. And so I'm sorry if I wasn't clear on that. I am not suggesting that the people and the attendees here start converting to an accrual basis from a tax purpose.
Got it. Not for tax purposes, but more for the overall story of how your business is performing, so you can start using the financial data to help you run your business, right? It's not just a scorecard at the end of the month. How much money did I make? It's really helping you inform how you make decisions, how you operate, how you think about fleet decisions, things like that. It's really a useful part of how you run your business.
I might be repeating myself a little bit, but let's just take a analysis or an example, not an analysis, but an example. I'm in March, or let's do this. In January, just close. January of 2024, on an accrual basis, my books showed a $30,000 loss. But I didn't report on an accrual basis. And on a cash basis, it showed a $20,000 net income because of whatever happened in the past. I'm now operating my February potentially on the idea that I'm doing 20,000, not knowing that I'm now going to see a cash loss potentially in the next month. Now, it never meets one-to-one. I, as a business owner, as somebody that relies on financials, would like to know that immediately in January, and if I need to make any adjustments in February, as opposed to having to wait till March to make the adjustments.
Makes sense. What are some of the biggest risks for businesses to fail?
So I always say that if you're not selling, if you're not creating revenue, well, you're going to fail. I mean, that's the reality. And so I don't ever want to take away from the fact that we have to continue to be able to sell. And equipment rental, except for some more unique perspectives, is more of a one-time sale. I mean, you're always having to find the next sale, the next rental, the next leasing. You might have clients that lease continuously, but it's more of what we call a project-based flow. So it's not a reoccurring. So sales is number one. Can't take away from that. Number two, and not to be self-fulfilling here, but number two is financial management. The organizations that we see, the small businesses that we see that fail, are the ones that don't operate understanding their numbers. They get surprised when they have losses, and then they don't adjust to the ebb and flow of the business in time to potentially weather out a storm.
Yeah, so your top two things, you're obviously just not selling anything, you're not renting anything, and then there's a lack of financial management.
Financial management is financial awareness.
Yeah.
And planning. The other thing I would say is, when we talk about cash flow, is do you have a line of credit, but also have you set yourself up to weather storms? Have you set yourself up to be able to go through a period of losses if, hey, I started my company in 2006. My experience was mostly in the construction arena. Most of my clients were in the construction arena. 2008 hit, and guess what happened to a lot of my clients? They didn't go out of business, but they started not being able to pay their bills.
Pretty close to it.
They had a lot of challenges. We lost clients, not that they went out of business, but because they couldn't afford to pay. All these things kind of transpired at that time. And we had to, one, react to that, shift industries. We actually, went in and we looked at what industries are more protected from a recession. But we also had to have the planning and awareness that we could weather that storm, that, hey, as owners, we had to shift our compensation. We had to do different things. And so planning around financial management, financial awareness is a key component.
How recession-proof do you think the equipment rental industry is? I mean, you lived that in 2008, 2 years into starting your company.
So it really depends on what type of equipment, right? I would think in a recession, a small tools equipment rental would potentially see a boom because you have more people doing DIY things as opposed to hiring contractors to do the work, especially in higher, I should say higher, in the mid-class regions of the country. If I take a heavy equipment rental company or leasing company that primarily provides equipment to general contractors and specialty trades within the commercial construction realm, then a recession that decreases commercial construction would have a more impact on that. So I don't have a general answer that suffices to everybody. But what I would say is, even in 2008, there was work still being performed. There was still contracts. And those companies that reacted and didn't just hope that it was going to one day stop and actually change business models and affected change, they weathered the storm. Those businesses that didn't change, that just hoped that by mid-2008 it'd get better or whatever that looked like in their heads, and they just sort of stood still and prayed, for lack of better words, I think those are the ones that really see, are at risk of failing.
Yeah, I think there's also a theory in equipment rental that in recessionary periods, builders are maybe less likely to go make big capital purchases and buy new equipment themselves. So maybe they're going to be more likely to rent. That's something I've heard from people as well.
Yeah.
I had a question. You mentioned line of credit earlier and sort of shoring up the balance sheet a little bit just to be prepared for when bad times come. How should a rental business think about that? Does every rental business need a line of credit? When do they add that? When should they think about adding that? How do they think about that?
Well, I'm going to be a little bit boy with you. I'm going to say that's a bad question, but it's not. Adding equipment rental into the question, it takes away from every business should have a line of credit. It's not just equipment rentals. And so I was being a little facetious. The answer is absolutely every single one. Rule of thumb. And you had a guest on here that talked about this, that had a lot more knowledge around credit and credit risk and so forth. But rule of thumb typically is 10% of your gross revenue to have in a line of credit. That is always a good rule of thumb. That's what we maintain. I can tell you that the last time I tapped my line of credit was right as COVID was happening, because we were more worried that the banks weren't going to weren't going to actually release line of credits if run a line of credit. So we figured just take it and stash it. But before then, I can't remember the last time I used it. That's great for me, but it doesn't mean that I don't continue to increase that available line and keep that as part of the facilities available to me to operate my business.
I think Ami Kassar is one of our previous guests. He was sort of like, the worst time to get a line of credit is when you need it, because you're going to get the worst terms. It's almost when you don't need it is when you want to start adding that to your business.
Yeah, I think a banker once said to me that, banks really will only give you an umbrella on a sunny day. Don't be raining.
Yeah. So really every business should have a line of credit, not even just rental business, is what you're saying. But obviously this audience is a rental business, but every business needs a line of credit. And you're sort of saying 10% of gross revenue is sort of rule of thumb.
That's kind of rule of thumb. I'm not saying that that's an absolute, and you're going to go and you have to get underwritten. You're going to talk to your banker. They're going to offer you something, and maybe if you're a first time client or you're more of a startup without a history, they're not going to offer you a 10%. They might offer you a smaller. Hey, let's start off at 25K. Start it, and or even 10K. I mean, I'll go back to, and this is such a silly statement, but I'll go back to high school. I got myself a secured credit card when I was 15 years old or something like that. And if anybody doesn't know what a secured credit card is, I had to deposit $100 or $200 into a bank to get a credit card to give me credit of $200. But then I would use the card and pay it off, not using that security, to then gain credit, so that when I got to the point of wanting a credit card, it was easier for me to get it.
Yeah, that makes sense. I mean, what are some other things? We talk about rainy days, getting a line of credit, something we should do. What other things should a rental business think about to help prepare for those rainy days that inevitably come to every business?
I'll go back to more generic again. I mean, rainy day preparation. Don't overextend yourself. Your best year today might not be you might not maintain. Too many times do I see business owners. I'm thinking of one in particular that had this stellar year. Everything looked like it was going to continue that way. It made, I don't know, personally, $500,000 in revenue, and a contract the next year dried up. But he had bought a new house. He had gone and spent all this money to do it. And all of a sudden, he didn't have the same money to live and operate. And now he's scrambling to live and operate at the same time. I've always been, it's kind of weird, I've always had more of a risk tolerance on the business side. Let me go grow. Let me go attack what I want to do here. On a personal side, be more conservative. I don't have a house. I don't have the biggest house that I could have. I don't have the nicest car I could have, and so forth. And I think smart business owners put themselves in a position that says, hey, not only am I making good money, I've set aside, I have 6 months of my personal expenses set away. I know this is more of a financial planning statement, but this is how you weather storms. And hey, I have 6 months of personal stuff, and I have another chunk of money that I can loan back to the company if I need to. Small things like that. So I'll actually go into a personal thing. I was talking to my financial planners, and I said to them, look, I want the 6 months. I want this amount of cash available, liquid. Hey, typically at my age, I'd be at about an 85 to 15% split when it comes to stock to stock to cash equivalents. More of an aggressive. So I have a very aggressive asset that's not being tracked by you. And here it is. Let's talk about what that is and what that value is. And now let's move maybe to a 75, 25, 80, 20 split on my investments, so I have a little bit more cash and cash equivalents on this. And so that gives me the flexibility, one, to make decisions. Hey, I want to invest in this with my business because I want to go from 2.5 million to 5 million. I know I'm going to have to hire a operations manager at 150,000, but I might not have that available net income within the business to actually support that if I continue to take money out myself. But I have a plan on how I'm here to there, and I just need a bridge.
Mm-hmm. So interesting. At least for you're a little bit more conservative in your personal life, but more aggressive in your business. Is that personal for you, or is that just general advice that you would also share for other business owners? Like, to think about those two things a little bit differently.
It's a very dangerous question to answer. I'll tell you why. Everybody has different risk tolerance. And again, to go back to the previous guest, he had a lot more information on that and talk far more on that, but your risk tolerance dictates your decision making. Okay. And so I'm not one to tell you that my way should be your way. What I'm telling you is that don't rely on this year, if this is a really great year, that next year's gonna be the same and operate now up to the next level. I've just seen so many business owners that change their lifestyle and their approach to more of a moment in time than something that's been proven to be long lasting.
Mm. I hear what you're saying. So if you have a great year, don't go buy the new house. Have 10 great years, and then let's, like string it together.
Let's just have a degree of consistency.
Yeah.
And so,
And you mentioned that group, the customer who had the big client fall through. Were you able to see, sort of, I guess, foresee that coming? You look at their books, you may be looking at the story. You maybe didn't say that particular customer is going to fall off, but in your mind, were you able to start thinking, hey, this may not be something that continues for the next 5 years? You may want to be a little bit cautious here.
So that client I actually got after that had happened. So I didn't really have any insight at that point. But what I would say is, again, let's say that you're more on the commercial space and equipment rental as opposed to like B2C versus the B2B. And let's say that you have $1 million in revenue, but 300,000 of that revenue is one customer. Because you have that one relationship. That's a risk profile within your business. So is that if you have one customer that could take off 30% of your revenue, that would give me pause of hanging my hat. Because the likelihood that you have the same customer for the next 10 years might be really good, might not be really good. It really depends. Depends on their personal success, depends on their business decision making, on whether they buy equipment. It depends on your relationship with them and how much they like you today versus tomorrow. So I would say if I have $1 million, this is the way I look at it. If I have $1 million of revenue with an average client value of $1,000, I'm super diverse. Now that comes with its own challenges. But if I have $1 million of revenue and I have 4 clients, I'm not super diverse. And I have a lot more risk around the potential fluctuation of my revenue.
At least for, we're a software company. What I've seen from different benchmarks is like software companies sometimes get dinged if one customer accounts for more than 20 or 25% of revenue because they're not diverse. But that's sort of what you're saying in your example. Like it's good to have some big customers, 5%, 10%, but maybe once you get above 20%, that starts to become a risk because losing that one customer could be pretty detrimental to the business.
Yeah, I'm not saying don't take the customer. I'm just saying
don't count on that customer being here for 100 years and planning and spending your money like that, right?
Sometimes, when I've seen that for my own self, I've looked at that as opportunity, opportunity to reinvest in the company. Like this is a moment. I might get a big implementation project, or I might get a big cat cleanup project, and it's going to be a 6-figure job. Well, I'm not planning on that job being available 6 months from now, but I can deploy that profit in a certain way. It might not be, and it might have everything to do with what my next set of plans are for the business, for where I want to take it, where I want to invest for my team.
Are there other warning signs? Let's say someone comes to you, hey, I had a great year, and you look at their books. What are some of the things that would make you concerned that it may not be something to bet on? Having one customer at 30% of your revenue. What are some of the other things that you would say, hey, let's be a little bit more conservative on how we forecast this because it maybe is not as good as you think it is?
A year can be a pretty long time period. So now, what does it look like month over month or quarter over quarter? Let's say that you had a great year and ended up with a high profit margin, but all that was made in the first 6 months. The last 6 months wasn't as profitable. What does it mean for the next 6 months? So you start digging into time period analysis, changes in cost over that period of time.
That's the trend analysis is part of it, is understanding, like, is it ramping up or is it ramping down? I mean, your experience, obviously, like a lot of people we talk to, including ourselves, we want to grow. It's like the natural orientation is towards growing your business, that's seen as a good thing. Can companies grow too fast? Is there a danger to actually growing too fast in your experience?
Absolutely. It's like anything else. You work on sort of foundational elements of your business. Okay. So your business is based on, think about your clients that were managing equipment rental before they had Quickly versus after they had Quickly. So before they had Quickly, if they grew really fast, how are they actually operating the rental side? Is it all phone calls and paper and a not great system versus how you can scale with a system like Quickly? So I see organizations that grow faster than their infrastructure can allow. Growth is also a personal decision. Growth is a decision that I've met many business owners that get to a certain level and they're really, really happy at that level and want a quality of life business. Hey, I'm making $200,000 to $300,000 a year or $500,000 a year, and that's all I need. And I want to grow. I feel comfortable in this, and this is where I want to be. You have other people that are never satisfied with where they're at. You have other people that grow from a intentional purpose when it comes to competitive analysis. What I mean by that is you have people that feel the need to grow because they're seeing risks within the overall industry. So first of all, ask yourself why you want or not want to grow, and then figure out what that pace is. But absolutely, I think there's too slow growth. You want a certain level of growth to stay relevant, even if you're happy. It could be 3 or 4%, but like if you don't grow at all, you have a risk of losing. I always say that complacency kills. I see too much where business erodes when people get too complacent. So there's nuances.
Yeah, I'm reading Nick Saban's book. I'm not an Alabama fan, but I like Nick Saban. He said you're either growing or you're dying. On some level, your business, your default, if you don't want to be dying, it needs to be growing at least some level. And then there's people who want a lifestyle business. They don't need to be the next Facebook. They just want to have a business. They can make good money, provide for the family, not work too hard. You mentioned, going back to the topic of growing too fast. I can see that when you talk to a rental company and they're all over the place and things are flying around, and you get a sense that maybe they're growing too fast. Like, can you see that in the numbers? Like, what about their balance sheet or in their P&L can tell you that, hey, these guys maybe aren't as efficient as they maybe should be?
So it's probably efficiency. It's sort of like when we grow too fast, we don't focus on the details. So our average rented hours, if you want to say that, per item start to decrease. So our gross profit decreases because what we're doing is we're chasing growth, which means that we're buying things at a pace that we're not actually putting them back into the field fast enough. So now our gross profit is reducing. And where is that right balance? And there's conversations around what that right balance is, and understanding that there's the highest gross profit means probably a slower growth pattern, and the lowest gross profit means you're probably either really not good at operating or trying to drive way too much growth. And what is that mid ground? What allows you to grow at a steady pace while utilizing your gross profit to do so? If that makes sense.
Mm-hmm. Yeah.
Wait, exact number, because again, the type of equipment that you're leasing is going to dictate this. I mean, there's a big difference between having to purchase a $500,000 piece of equipment versus a $1,000 piece of equipment to put into your portfolio.
And I think it goes back to what's your goal? Are you building a lifestyle business, or are you someone who's just relentless and just wants to keep growing as big as possible?
Your growth is really going to tell you a lot about how you're operating from an efficiency perspective, I guess, is the key that I would have the attendees take away from.
And sorry, did you say revenue growth?
Cost of goods sold.
Cost of goods sold. Got it. That's like the number one thing to think about as you think about how efficient your business is. Yeah. And I think just for software companies like we are, there's people talk about the rule of 40, which is your margin plus your annual growth rate, and those together should be at 40% or higher. That's like a way to think about profitable growth, and like that's just rule of thumb. There's a lot of different ways, but there's always a balance of growing healthy, but also growing sustainably. I worked at Uber, and it was not sustainable growth. It was grow as fast as possible, burn billions of dollars. Those days are sort of behind us, I think, a little bit, at least in software with interest rates, and et cetera. But I think for a lot of rental companies, it's you want to grow, but you have to be sustainable and profitable, something that you can build on consistency year over year. That way you can start to take money out of the business and, fund your lifestyle, not this lumpy, spiky thing that maybe puts you in a bad spot long term.
Well, I think, go back to Uber, some companies decided to drive growth through what we call land grab, and it's not about profit. I don't think that's relevant necessarily to the industry that we're talking to, but that is a very dangerous model. Because at some point, you got to shift what you're doing. You have to lay people off, or you have to increase prices. You don't really have a choice.
Mm-hmm. Yeah, I mean, I've been in software for 10 years. I've seen that. Those days are sort of ending. I don't know if you work with many software companies, you've probably seen that too. There's been a big shift towards profitability. I think that's sort of happening in the broader macro environment too, as well, not just software.
Yeah, I would agree with that.
One of the questions I was talking to your team about was biggest challenges facing the accounting industry and how that can impact, these the businesses. Can you talk to me a little bit about that?
Yeah. So what we're finding, it's not what we're finding, I shouldn't say that. What we've published and what the research shows is just where the available resources from people are within the accounting industry. So in the next 10 years, there's an expectation that 75% of CPAs or accountants will retire. That in 2023 alone, 16% retired. And college graduates coming out of university and then sitting for their CPA are down 30% from 5 years ago, which means that we have a huge shortage. It's already started in the accounting and tax realm. This is where I also think that outsourcing is becoming more and more prevalent in the industry as a whole, because our job as a outsource provider is how do we provide services that are value added to the client as efficiently as possible. And we're able to take one individual or one team and deliver those across multiple companies. So I don't think it's being talked about enough outside of the accounting industry, but there's a lot of concern. And personally, I believe that the utilization of AI is going to be necessary to combat it. The Wall Street Journal talked about the accounting industry being one of the most affected by AI, but in the next 10 years, 50% of, I'm not sure if they use 10 number of years, but that 50% of tasks that accountants do will be automated by AI. If I have 75% leaving the workforce, I still have a delta of 25%. So we're still seeing a shortage there. And it's a big risk to accounting firms. It's a big risk to businesses in general, because as we become a more global economy and a global presence, there is this true nature of a more competitive arena. Now, what I will say is that in the equipment rental space, you're not as globally competitive. What I mean by that is your equipment is in a certain area, and there's a certain area that you service. So you're insulated a little bit more. But you're still dealing with more advanced organizations that spend more time, whether it's marketing, more time, whether it's operationally or investing in things like Quickly, that give the competitive edge, and it's easier. The entryway to industry is easier today than it was 20 years ago.
I did not realize just 75% CPAs are going to retire in the next 10 years. It's a lot. I imagine that's probably a blessing and a curse for you guys. That makes your product more in demand, but also you're going to have to find people to support the growth too, right? I imagine you're probably starting to see a little bit of both of those things.
Yeah, no, it's a challenge for our firms because of turnover. I mean, in the professional service realm, the biggest costs, and if you talk about efficiency, the biggest cost is when you have to hire new or have turnover because it's training. So there's this curve for us of how quickly we can get people trained up and be, fully profitable, fully utilized. And so that's a risk to us. The risk, what we're hearing from a lot of clients that we're talking to today that are coming in and and looking for services is, hey, I had this bookkeeper that I've had for 10 years. They retired. I then hired this person a year ago, and they're just not cutting it. And that's the story after story like that, because you're taking individuals that have been with an organization for a long time, had institutional knowledge, and replacing it with people that are younger, less experienced, that hadn't been in that organization.
There's definitely tribal knowledge. I mean, we went through a couple accountants early on, and every time we luckily had the same person. At some point, inevitably, she'll leave. I mean, it's going to be hard to go through that transition. And it's interesting. Like, we talk a lot of rental companies. There's a huge narrative around being short operators and mechanics, big time in the rental industry. I'm just wondering, like, where are we just short people at some level, like skilled people? Because you're telling me accountants are short. The equipment rental industry is going to be short on people. I mean, I don't know. This may just be a broader labor problem we're talking about, but obviously it's very specific to the accounting role as well.
Well, the accounting, there was a lot of components that added to it in our industry. 150 credit requirement to sit with CPA. A lot of people decided to go finance and MBA because it had a different career track, quite frankly. I think that played a big impact in it. So that's one piece of it.
Yeah. Got another question. Also, we dropped, Matt, your link here in the chat for anyone who wants to book, complimentary consultation with you and your team. Definitely would recommend it. That's in the chat here. Also, just for people listening on, a podcast later on, Matt, what would be the best way for people to get in contact with you?
Yeah. So if you just reach out to us at sales at L- or -W as in watermelon consulting.com, that would be great.
Cool. I do want to get to one more question now. I just want to make sure we plug that before I forget. Question from the audience. Is it important to work with accountants that are local to your business so they know about all the city, county, state aspects you might be dealing with? I know for the equipment industry, because we're in 50 states, every state, county, different taxes. Colorado in particular is horrible. How important is having a local accountant to your region as a rental business?
So this ends up being a personal question. I don't want to take away from the comfort that having somebody that you can drive and see, and that some businesses have. What I would say is we've been completely remote since 2010. COVID changed nothing about our business. We have staff, I think it's 27 states or something at this time. And it's our job to maintain knowledge around Nexus and state issues that come to like tax and things of that nature that are important to the internal accounting component. Now, your tax accountant, in which you have state taxes around your personal taxes, could be a completely different matter for you. You may want to have a tax firm that really understands the nuances of state and local tax. The fact from our perspective, your Nexus and your state tax stuff is something that in some instances changes all the time anyway, and other instances are pretty common across states.
That's a good answer. And just gets in my brain, I want to go back. I'm very interested in AI. We're launching an AI feature within the Quickly software in 2 weeks. I'm very excited for our first foray into this. Have you guys been experimenting with AI yet? On the accounting side, or is that something that you see coming in the future, but you haven't really gotten, your feet in the water yet?
Us personally developing AI products, no. But most organizations, I shouldn't say most organizations, but there's a lot of organizations that end up utilizing AI without even knowing it. If anybody in this audience as an attendee has used Bill.com, they have AI, embedded in what their product is. If Quickly is once you bring out your AI, that's going to be embedded in what they're utilizing. We will be investing in the future around AI development, around some of the software components that we're starting to invest in currently. But that's not our main value weight.
Right. You guys aren't developing artificial intelligence software. That's not your core business, but you will leverage it once it's ready.
But we already leverage it.
I use ChatGPT every day. I don't know if anyone, my team makes fun of me because I'm always, every day I'm in there doing something, but.
Your marketing. My marketing person says that ChatGPT, she refers it to her assistant.
Yeah. I mean, seriously, I use it every day. We can get a whole separate topic about it, but I get a lot of crap from our team about it. They think I'm obsessed with it, but hey, it works. I know, Matt, we're just out of time here. I guess final question or just feedback for, rental business owner. What's the biggest takeaway from this session that they should think about as they go back to running the rental business?
Look, invest in your accounting, invest in your financial management. Whether that's your personal time, you hire an internal person, or you outsourcing, you will be more successful in the long run if you do that. Simple as that. And that would be the biggest takeaway.
Love it. Well, thanks, Matt. Fellow Marylander here between the two of us, crab cakes and football. It's good to have you on the podcast. Thanks for coming.
Thank you.
All right. See you guys. See everyone.